like the strategies that are available here are almost endless, and there's
Right.
probably something that almost everyone is missing.
Peter, so good to see you. Welcome back to everyone. Today we're going to talk about the 4 best investments for minimizing or avoiding taxes. Investments typically generate income and trigger taxes in 2 ways: capital gains and dividends or cash income. So Peter, let's walk through the best options when it comes to tax-free, tax-exempt, or investments that offer tax breaks. And I know this is important to you because tax strategy is always top of mind with you and clients.
Yeah, well, it's not what you make, it's what you keep, and
Yep.
taxes are typically the biggest expense standing in the way there. And taxes are a little bit of a double-edged sword. I mean, nobody likes paying taxes, but it means you made money, so it is a good problem to have. And then again, kind of two sides of the coin here. Sometimes we focus on being tax efficient and miss opportunities for higher returns or vice versa. So you have to weigh the pros, the cons, the disadvantages, very carefully here. And a lot of people kind of look back at what they owed last year and not enough looking forward at what they will owe into future years. So those are the conversations we have with our clients.
Right. Okay. So now let's get into those investments. First, we have municipal bonds. Unlike conventional bonds where interest income is taxed at your ordinary income rate, muni bonds offer tax-free interest income at the federal level.
Yeah. And here again is an example of don't step over dollars to focus on dimes, is that yes, muni bond interest can be tax exempt at the federal level, but sometimes they pay a lower return. So if I am in, let's just say, the 25% tax bracket, tax rate, and there isn't one, but just for easy math, and a muni bond is earning 4% versus I can get a taxable bond that is earning 6%. Which one do I net out better? I get a higher rate of return and have to pay some taxes, or I get a lower rate of return and don't have to pay those taxes. You have to weigh that very carefully. So I hear problem, and I know it is a problem that people don't like to deal with. But again, paying taxes at certain points can be a good problem to have.
And that income from muni bonds affects the taxes you pay with Social Security.
Yeah, another aspect here that you've got to add into the equation. It's not just one part of the tax code that any of these things are going to impact or be negated from, is that they've got ancillary consequences that may not affect you right there within that particular investment, but they have other contingencies that they do impact. And that equation for what if your Social Security is taxable, how much of it is, the interest from tax-free muni bonds still is included in that equation. And I know we've got this temporary offset deduction, but perhaps for those that are really, really concerned about generating more tax advantaged income or gains in their portfolio, are already eliminated from an income standpoint from getting those extra one big beautiful bill Social Security offsets of $6,000 a person, because those are income throttled and eliminated.
Right. Next, we have tax-exempt money market funds. How do these work?
Yeah, well, generally these are money market funds that are tied to the same municipal bonds here, and like 80% of the money market fund has to be encompassed or incorporated, built on that. But same kind of chassis here is that, and discussion and evaluation is 6 1/2 dozen in the other. If you're getting the same interest rate, of course you want the more tax advantage fund. But if the interest rate off of taxable funds is going to be higher, you have to look at that higher rate that you're going to earn and do some backtracking, reverse engineer. Okay, well, at my tax rate, how much am I actually going to keep? What is my net? And is that going to be equivalent or higher than the tax-free version?
Next, we have Series I bonds. These were really popular a few years ago, and EE bonds.
Yeah, well, the I is the ones that are inflation linked. So as the inflation rates were high, back in 2021, I'm feeling old for a second. Those rates were really nice. They were up at like 9.62%. They have fallen, of course, because they are linked to inflation. So as inflation has come down, so have the rates on those I bonds. But yes, the interest from that federally tax exempt. EE bonds, the same, state and local tax exempt rather, and then can also be federally tax exempt on the EE bonds if those proceeds are used for education, which in many cases they, that is a perfectly legitimate strategy and a great way to avoid an yet additional layer of taxation.
Next, we have Treasury bills. While T-bill interest is subject to federal income tax, it's exempt from state and local taxes.
Yes. So, several of these different items taxable on one side, maybe exempt on the other, including like in my state, North Carolina, even Social Security. They don't tax it at the state level, whereas your income dictates and determines if it is taxable at the federal level. So the Treasury bill income is yield rather is going to be taxable federally, but state and local taxes, it is exempt for that. So depending on what your state tax rate is, that could be a big deal in states like Illinois and California, no deal at all in maybe a state like Florida that doesn't have a state income tax, several others there. And you just have to kind of determine what makes sense for your situation and if that is a big advantage or not.
And of course, when it comes to tax advantaged accounts, Roth IRAs can often provide bigger savings than even chasing all of these tax-free investments. I'm sure this is what you mean by stepping over dollars to get the dimes.
Yeah. And this is encompassing the entirety of the account inside of certain tax protections. So with any investment that you choose, you need to look at the status of the account in which you place it. And certain investments are better for tax efficiency than others. Certain investments are better for legacy to be left behind. They may receive like a stepped up cost basis, but you put things inside of the bubble of a tax advantage account, whether that be a tax deferred traditional IRA or a tax free Roth where you've paid the tax up front. And that changes these tax implications of the investments themselves. The bubble that you put it in overrides the innate tax nature of the investment itself. And so even things like life insurance strategies and annuities in certain cases, Erin, can be effective tax management strategies. If you've got a bunch of money that is sitting in CDs, that interest each year is going to be taxable to you. You may be able to put that into a annuity or perhaps even a life insurance vehicle if you are planning on those dollars sitting there for a long period and perhaps passing to the next generation. These can be highly effective tax mitigation strategies. You don't get the 1099 on the interest and the growth each year. If you've got appreciated non-qualified assets, those that are not in these different accounts, there are strategies, tax loss harvesting, maybe generational gifting, looking at the cost basis of these things. All of these are going to be important for you to know and understand and control your ultimate tax liability. And that's what we try to look at with our clients, and where necessary, bring in the help of accountants or CPAs if we are executing on any more kind of advanced tax strategies.
I'm going to be honest, Peter. This sounds like way more math than I would enjoy doing on my own.
Yeah, well, there's a lot that goes in. And, what's funny is like the IRS knows what you owe them. You have to do all of this math yourself. And then they're like, nope, sorry, you got it wrong. Figure out
right,
later.
That too.
But like the strategies that are available here are almost endless. And there's probably something that almost everyone is missing. For instance, like if you're over 70 and a half and you're tithing or charitably inclined, doing that through your IRA rather than cash, a huge strategy, a qualified charitable distribution. And these are things that people miss all the time that could be costing them dollars that they could be keeping or putting to, your own life's enjoyment. So it's a reason why, Erin, you want to speak with somebody who is versed in this, experienced and qualified, and really understands not only the investments and the growth that they will generate, but how they will be taxable to you or to the next generation.
Right. You don't know what you don't know. Peter, if somebody would like to sit down with you then to learn more about this strategic tax planning, what's the best way to reach you?
Give me a call at Richon Planning. Maybe not fun to everybody, but we thoroughly enjoy it, Erin, and like to have these conversations. So you can reach us at 919-300-5886, 919-300-5886. It is one of the pillars of the 5 critical areas in planning that everyone should have a plan that addresses. We call it the optimized retirement plan. Income, investments, taxes, healthcare, and legacy all should be addressed. And we are happy to do that with folks. So again, give us a call, 919-300-5886, or you can visit the website, richonplanning.com. Email me directly, Peter at richonplanning.com.
All right. Peter, thank you so much for your time today. I really appreciate it.
Yeah. Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.